Imagine a company that functionally holds a monopoly on the most important technology of the 21st century.
Right.
I mean, it's up 134% in a year. Its own CEO is pouring his personal cash into buying the stock right at record highs.
Which is crazy to see.
It is. Yet if you looked at the ticker yesterday, it's dropping. So today, we are bringing you right into the center of the ultimate market mystery. We're doing a deep dive into Taiwan Semiconductor Manufacturing Company, or, TSM.
The setup here is genuinely fascinating because, well, the narrative is splitting right down the middle in real time, as of yesterday's close.
That's April 20th, 2026, for anyone keeping track.
Exactly. April 20th, 2026, the stock sat at $366.24. It dropped 1.15% in a single trading session. But zoom out and the context completely changes.
Right, because year to date, it's still up over 14%. And over the past year, an explosive 134% gain.
Yeah, a massive run.
So for you listening, the mission for this deep dive is to answer the million-dollar question. Are we looking at a minor falling trend that acts as a glaring sell signal?
Like technical fatigue is finally dragging it down.
Right. Or is this a screaming strong buy for a fundamentally undervalued juggernaut? Like, are retail traders looking at yesterday's dip and walking straight into a classic value trap?
Before we break down the mechanics of what's happening, let's establish the boundaries of the playing field here.
Okay, let's unpack this. Evaluating this stock right now is like looking at a race car that just set a track record but is pulling into the pit stop. Do you bet on the driver? Or do you worry about the wear on the tires?
That's a great way to put it. Just to frame the stakes, this stock has an incredibly wide 52-week range. Exactly 1 year ago today, on April 21st, 2025, TSM was sitting at a low of $145.84.
Wow.
Yeah. And by February of 2026, just a few months ago, it had skyrocketed to an all-time high of $390.21.
Now, I want to explicitly remind you as we get into this that our deep dive today is an objective analysis. We are pulling directly from the financial data, the technical charts, and the market reports provided in our sources.
We're just looking at the facts.
Exactly. We are here to help you understand the mechanics behind the headlines, but this is absolutely not financial advice.
So the first place we need to look to understand this massive climb and, the recent hesitation is under the hood at the fundamental business. TSM just released their Q1 2026 earnings.
Fresh data.
Fresh data, yeah. And it gives us a very clear picture of what this company is actually worth right now, divorced from the daily noise of the stock market.
And the numbers in these newly released earnings are honestly staggering. I want to break this down because reading a spreadsheet is one thing, but understanding the scale of this growth is another. Let's look at the income statement comparing Q1 of this year to Q1 of 2025. Net revenue hit $35.90 billion.
Which is a 40.6% increase year over year.
Net income reached over 572 billion new Taiwan dollars, which is up 58.3%. And earnings per share came in at $3.49.
Easily blowing past the Wall Street consensus of $3.36.
Right.
Those top-line revenue figures are massive, but the mechanism that actually makes TSM such a powerhouse is hidden a little further down the income statement. I'm looking at their margin power here.
Oh, yeah.
Gross margins are sitting at an astonishing 66.2%. Operating margins are at 58.1%.
Let's unpack that, because a 66.2% gross margin on physical manufacturing is wild. We are talking about a company that deals with physical atoms here.
Not just software.
Right. They are manufacturing silicon wafers, which are arguably the most complex microscopic structures in human history. Usually you only see margins like 66% in software companies that just hit copy and paste on a digital subscription.
If we connect this to the bigger picture, that's the critical distinction. A 66.2% gross margin on a physical good isn't just a sign of efficient factories.
What is it then?
It is a mathematical proof of extreme pricing power. TSM operates as the sole supplier for high-end AI chips for tech giants like NVDA and AMD.
Right.
The mechanism here is simple. Nobody else on the planet can manufacture these specific, highly advanced chips at the scale and yield rates that TSM achieves.
So because there's no viable alternative, TSM doesn't negotiate prices.
They practically dictate them.
They are the only game in town. If NVIDIA wants to power the next generation of artificial intelligence, they have to pay whatever TSM asks.
Yeah.
And that pricing dominance is creating just a fortress on their balance sheet. The sources show they are sitting on 3.8 trillion new Taiwan dollars in cash and marketable securities.
It's a mountain of cash.
Their operating cash flow for Q1 alone was almost 699 billion new Taiwan dollars. And their free cash flow, the actual cash left over after running the business, is over 348 billion. Plus, despite all the money they spend, their debt-to-equity ratio is only 19.71%.
A sub-20% debt-to-equity ratio for a highly capital-intensive manufacturing company is almost unheard of.
Really?
Yeah, I mean, it means they are generating so much organic cash from their daily operations that they suddenly don't need to over-leverage themselves with bank loans or corporate bonds to fund their growth. They are financially bulletproof.
But this is where the narrative splits, and we need to figure out why, because these numbers are astronomical. So if the revenue is growing at 40%, the margins are record-breaking, and the balance sheet is basically drowning in cash.
Why did the stock drop yesterday?
Exactly. Why did it drop 1.15%? Why isn't it just going up in a straight line? If the balance sheet is basically bulletproof, why are we seeing any short-term weakness or consolidation at all?
Well, the discrepancy comes down to the difference between fundamental valuation and technical behavior.
Okay.
The fundamental data, the earnings, the cash flow, that tells us what the company is objectively worth over the long term. But the technical charts tell us how human psychology, institutional momentum, and trading algorithms are behaving right now.
This week.
Right, this very week.
So let's translate that technical behavior for the listener. The spreadsheets show a juggernaut, but what are the actual trading charts telling us about the market's current mood?
Right now, the charts show a massive bullish long-term trend that is running headfirst into short-term consolidation.
Okay.
Let's look at the 14-day Relative Strength Index, or RSI. For anyone unfamiliar, the RSI basically measures the speed and change of price movements on a scale of 0 to 100 to tell us if a stock is overbought or oversold.
Got it. And where is TSM sitting?
Currently, TSM's RSI is sitting comfortably neutral to slightly bullish, between 51.92 and 61.22.
So it hasn't spiked up to 80, which would scream like everyone is buying in a panic, prepare for a crash.
Right.
But it hasn't tanked to 20 either.
Exactly right. But the more compelling technical event mentioned in our sources happened just a few days ago, on April 14th. The 10-day moving average crossed above the 50-day moving average.
Let's explain why that matters, because that's a big deal. The 10-day average tracks the immediate short-term mood of the market, while the 50-day tracks the medium-term trend. When the short-term trend line crosses above the longer-term line, trading algorithms and technical analysts see that as a classic buy signal. The short-term momentum is actively accelerating past the recent historical average.
And according to the historical data provided in the reports, this specific crossover event has a 75% historical success rate for predicting further upward movement.
Wow, 75%. That's high.
It acts as a trigger for institutional buying programs. Add to that, the MAD, the moving average convergence divergence, has been positive since April 2nd.
Confirming that upward momentum.
Exactly. When the MACD is positive, it confirms that the upward momentum has underlying strength. The engine is revving.
But the road ahead isn't entirely clear, is it? I mean, even with those buy signals, we are seeing daily dips.
Because every chart has a battlefield of support and resistance zones. These are the invisible price levels where buyers and sellers historically clash.
Okay, map out the battlefield for us.
Overhead, there is heavy resistance at the recent high of $375.58, and another ceiling further up at $383.88. As the stock pushes up toward those numbers, investors who bought lower start taking profits, which creates friction.
And on the downside, where is the floor if this recent dip accelerates?
Downside support currently rests at $351.37. If it breaks through that, there is a major psychological floor waiting at 340.20. Institutions will likely step in heavily at those levels to defend the price.
And we know exactly what kind of institutional pressure is driving this. The order flow data in our sources shows that high-performance computing, or HPC, now accounts for 61% of TSM's total revenue. This isn't retail day traders buying a few shares on their phones.
No.
This is the massive buy-side pressure of the global AI boom. But while the long-term institutional buyers are accumulating, the short-term options market is bracing for chaos.
The options pricing data is incredibly revealing here. Options market makers use a complex mathematical formula called implied volatility to price their contracts. Right now, the options market is pricing in an expected move of plus or minus $14.65 for the upcoming week of April 24th.
So what does this all mean? Let's pause on that because that is a massive detail for any retail investor listening. What does a plus or minus $14 expected move actually translate to? Are retail traders going to get shaken out by this volatility?
Well, it means the market makers, the financial institutions writing these contracts, believe there's a high probability the stock will swing violently within that range. It targets a low end of roughly 354 and a high end of roughly 384.
Wait, notice how perfectly that aligns with the support and resistance zones we just mapped out?
Exactly. So the risk here for a regular retail trader is getting shaken out. If you buy the stock today and set a tight stop loss to protect yourself, a sudden $14 downward swing will trigger your sale automatically.
Locking in a loss.
Right. Then the stock might bounce right off that $351 support level and rocket back up without you. You get chopped up by the volatility, even if your long-term thesis was correct.
The options market is basically pricing in severe turbulence. You have to respect those support zones, or the algorithms will just hunt your stop losses.
Yeah, pretty much.
Which brings us to a fascinating crossroads. If the technicals show this expected, violent volatility in the short term, how are Wall Street analysts and, more importantly, the company's own executives positioning themselves?
Let's look at the ratings. The analyst community on Wall Street is practically entirely aligned here. The overwhelming consensus is a strong buy.
Joker.
Right? Wall Street models aren't really concerned with a $14 short-term swing. They're looking at that 40% revenue growth. The average target price sits between $413 and $457.
And some are even higher, right?
Yeah, at the extreme bullish end of the spectrum, Needham has set a target of $480, and Alethea Capital is calling for a massive $600 price target.
Now, Wall Street analysts issuing high price targets on a popular AI stock is par for the course. Like you said, it's their job. But here's where it gets really interesting. Let's talk about the bombshell data point buried in our sources, which is the insider buying.
This is wild.
In late March and early April, insiders at TSM, including the CEO himself, Chechia Wei, made open market purchases of the stock totaling over $600,000.
The sources explicitly call this a historic anomaly, and it's vital to understand why. In the tech sector, C-suite executives are typically compensated heavily in stock options or restricted stock units. The standard, predictable behavior is for executives to periodically sell their shares on the open market to diversify their personal wealth, buy houses, or put it in index funds.
They rarely buy their own stock with their own cash because they are already so heavily exposed to the company.
Precisely. Let alone buying it when the stock is already up 134% in a single year.
Yeah. For TSM insiders, the historical data shows they traditionally rarely trade at all. So for the C-suite to buy in the open market near 52-week highs is a massive signal of internal confidence.
The CEO has access to the internal 3-year revenue projections. He knows exactly what the AI demand pipeline looks like, and his action suggests he believes the stock, even at these highs, is fundamentally cheap.
They are looking at a stock chart that looks like a rocket ship and saying, this is still undervalued. But how can that be mathematically true? If we look at the trailing PE, the price-to-earnings ratio based on the profits they made over the past year, it sits at 31.4x.
Which is somewhat high.
Right. For a massive hardware manufacturer, a multiple of 31 looks historically expensive. A retail investor might see that trailing PE and think, I missed the boat. The AI hype is fully priced in. If I buy now, I'm stepping into a value trap.
That is the core fear driving the bears right now, this value versus trap debate. But the stock market is a forward-looking discounting mechanism. You can't value a hyper-growth company based solely on the money it made yesterday.
Okay, so look at the future earnings.
Right. When you look at the forward PE, which factors in the projected earnings based on this incoming tidal wave of AI-fueled revenue, the ratio drops significantly. It falls to between 20.2 and 24.6.
Because the E in the PE ratio, the earnings, is expected to explode upward which pulls the valuation multiple down to a much more reasonable level.
Exactly.
That forward PE suggests the stock may actually be undervalued relative to its massive AI-fueled growth. It counters the fear that it's a value trap for retail buyers. The current stock price simply hasn't fully caught up to the reality of their future income.
It's a really compelling bull case.
Let me play devil's advocate here, though. I want to aggressively push back on this bull case because it sounds almost too perfect. Let's look at this skeptically.
Okay, let's do it.
This looks exactly like a classic market top. Everyone who wanted to buy the AI hype has already bought. The CEO is just doing some symbolic purchasing to trigger retail FOMO, and that beautiful forward PE is nothing but a fairy tale based on AI growth projections that might suddenly evaporate.
Sure.
Convince me I'm wrong. If the margins are record-breaking, the technicals show a buy signal the CEO is buying, and the forward PE implies it's undervalued. What is the catch? Why did the stock drop yesterday?
This raises an important question, and you have to stress test the thesis. Our sources outline three very distinct, heavy downside risks, bear arguments that could easily trap overly eager traders.
Okay, what's the first one?
The first is simply technical fatigue.
Which means gravity still applies to the stock market.
Essentially, yes. Trading this close to 52-week highs naturally invites profit-taking. Think about the institutional fund managers who bought heavy positions at $145 last year.
Yeah.
Their portfolios are now heavily unbalanced because TSM grew so fast. They are mechanically forced to sell off shares just to rebalance their risk. That heavy mechanical selling pressure explains the recent short-term weakness and the daily dips we saw yesterday.
Okay, so the first risk is just natural market physics. Portfolios need rebalancing. What is the second bear argument? Because this one seems much more fundamental to the business model itself.
The second massive risk is the Capex burden, capital expenditure. TSM is not a software company that can scale by just, renting more server space. To grow, they have to physically build the most advanced factories on Earth.
And that is not cheap.
No. Currently, TSM is spending a staggering $52 to $56 billion annually on Capex.
Let that number sink in for a second. Up to $56 billion a year. That is higher than the gross domestic product of several small countries, and they are spending it entirely on overseas fabs in Arizona and Japan.
This is an incredibly capital-intensive expansion. The mechanism of building these fabs is fraught with risk. It's not like pouring concrete for a warehouse.
Right.
These facilities house machines that cost hundreds of millions of dollars apiece. They require hyper-pure water systems, microscopic clean rooms, specialized labor, delays, extreme cost overruns, union disputes, supply chain bottlenecks.
Any of these can cause that $56 billion budget to balloon, which immediately eats into those 66% profit margins we were just celebrating. It is an incredibly heavy financial anchor to drag.
Exactly.
It sounds like TSM is building the world's most profitable toll booth. Every major tech company in the world has to drive through it if they want to get to the AI future. But this particular toll booth happens to sit directly on a tectonic fault line. And because everyone knows the earthquake is a possibility, TSM is forced to spend $56 billion a year to try and hastily construct backup toll booths in the deserts of Arizona and the islands of Japan.
That is the perfect metaphor for the third and most heavily debated risk, geopolitics. Both the market reports we looked at highlight the heightened tensions in the Taiwan Strait.
Right. And to be clear to you listening, we are simply reporting the objective geopolitical realities mentioned in the sources here. We're not taking sides. But this geographic vulnerability is the primary anchor weighing down TSM's valuation.
The market aggressively prices in risk. If TSM were headquartered in the middle of Ohio, with no geopolitical threat hovering over its primary manufacturing hubs, its forward PE would likely be much higher than 20.
But because of where they are physically located, investors demand a lower price of entry to compensate for the geographic risk they are taking on.
Exactly.
So, synthesizing all of this data from our sources,
the worst-case continuation lower assumes that the short-term technical fatigue overwhelms the buyers. Institutional profit-taking accelerates, the positive momentum breaks down, and the price gets dragged aggressively back down toward that $351 support level or even lower.
For you listening, this deep dive reveals a very clear dichotomy. In the short term, expect volatility. Expect a relentless tug-of-war between the profit takers and the AI bulls eagerly jumping in to buy the dips.
But in the medium to long term?
In the medium to long term, the sources project massive 30% plus revenue growth as mass production of highly advanced 2-nanometer chips ramps up through 2026.
That technological leap to 2 nanometer is profound.
It is. But, and this is the final provocative thought to wrap up the deep dive, this entire bullish thesis hinges entirely on one very specific assumption: global AI demand remaining insatiable enough to absorb TSM's massive production and pricing power.
Which leaves us with a critical, lingering question to consider as you watch this stock over the coming weeks. We know they have $56 billion committed to building new overseas megafactories. But if the global AI gold rush were to suddenly slow down, even just a little bit, before those massive new foundries even open their doors, how quickly does this supposedly undervalued growth engine become the most expensive value trap in the market?